Welcome everyone to the 2025. Uh, this is Pratt and LeFevre's Business Success Summit that we have something like this every year. And this year we're going to have three different sessions that we're going to have. Today we're going to be starting with Daniel McCraine. I'll introduce or I'll have him take over in a moment. But right now we're going to just give you a couple instructions. If you're live on this, you're going to be muted and you're going to have your video turned off. But what will happen is if you need to chat or ask a question of that person, you can put it in the chat, but they won't be answering it till after they finish their presentation. But after the presentation, they will answer it. If you have a general question, we'll answer that at the end. So I'm going to turn the time over to Daniel and we'll get going. Daniel, take it away.
All right, thank you very much, Boyd. Well, my purpose today is to introduce you to the strategy that we use with Pratt and LeFevre. The whole reason that Pratt and LeFevre is here is to help small business owners pay taxes and to run their business the way that the wealthy do. And I'm going to set the stage, first of all, by sharing with you a diagram that explains how our strategy works. So as I share this diagram, the first thing that I'd like to call your attention to on the screen, we'll just start at the very top here, is I'd like to draw your attention here to the once cash flow system at the top of the screen. Now you'll notice that once is an acronym, and this stands for own nothing, control everything. Now, this was the motto of the Rockefeller family back in the last century. I'm sure you know who the Rockefellers are, a very wealthy family. But this was their family motto. And what they believed, what they taught, and what we take away from this is if you own something, then anything that you own can be taken away from you if a legal lawsuit goes against you. And so what they believed is own nothing. Instead, what you want to do is you want to control everything. And the way that you do that is through these entities that you see here on the screen. And I'll be talking through these in just a moment. When you control things through corporations, LLCs, or trusts, then you have all the benefits of ownership, but you don't have that liability, you don't have the risk of anything being taken away from you. And this is what the Rockefeller family taught. So this is what the wealthy do. If you look at the wealthy in the world, if you look at Jeff Bezos, Bill Gates, Warren Buffett, they don't own the house they live in. They don't own the car that they drive, but they control those things through companies and through trusts. And so I'm going to break down our cash flow system for you today. I'm going to show you the strategy. I'm going to lay out the base work of what we're going to be talking about today. So everything we talk about today is going to be built off of this diagram that you see here on the screen. So let's look at pieces and parts of this diagram for a moment here as we get started. I'm going to start in the middle here. You'll notice that here in the middle we have a C corporation, which is the primary company that you use, that you run your business with. The C corporation is the public facing company. That's the company where you sell your products and goods and services. So you sell to the public through your C corporation. Now, we prefer to use a C corporation for a variety of reasons. So I'll break down some of them. I could go on for a long time, but we don't have that much time today. Some of the reasons we use a C corporation include the first one that I always like to bring up is with a C corporation, you are not required to pay yourself a salary. Now, you are a W-2 employee of a C corporation. That's the way C corporations work. But with a C corporation, you are not required to pay yourself. So what this means is that, first of all, the C corporation is paying less taxes because they don't have to pay the payroll taxes for your salary. And you are paying less taxes because now you have no income tax to pay on that salary. And I'm sure you're thinking, because this comes up a lot, I talk to a lot of small business owners. I'm sure you're thinking, well, that's great. So where do I get paid then? I'll skip ahead real quick. You get paid through your LLC, but I'll explain how that works in a moment. So let's continue with the C corporation here. So the great thing about that C corporation, like I said, no salary requirement. This is why we don't use an S corporation. Now, if you've got your business set up, some accountant, some business lawyer, tax lawyer helped you set up your business, they may have suggested that you set up as an S corporation. And I'm sure that was great. And if that's all the tax planning you do, then I'm sure that's fine. What we're proposing here is to go beyond that, to do advanced tax planning through your business. And one of the things you need to know is if you have an S corporation, if you are filing taxes as an S corporation, you are required to pay yourself a salary. So that means the company pays payroll tax, you pay income tax on that salary. So that's why we use a C corporation. There's no salary requirement. Now, C corporation can do a couple of other things which are very beneficial. A C corporation is allowed to provide perks or fringe benefits to officers of the company, and those are tax deductible to the company. So that's the great part about a C corporation. Those fringe benefits can include renting a house, a fully furnished executive home for you to live in. That includes renting a car for you to drive. And in some cases, your C corporation can even reimburse you for health and wellness expenses. So those are some fringe benefits that a C corporation can provide you. LLCs can't do that. They can't write off the expenses. S corporations definitely can't do that. You can't write off those expenses. It's something that only a C corporation can do. And so that's one of the advantages. Other things you'll notice here, the C corporation owns just very minimal assets, maybe $1,000 in the bank. And the reason we do that is for some liability protection. Because if anyone ever decides to sue your corporation, well, one of two things would happen. One is the attorney who's helping bring the lawsuit would do their due diligence. They would discover there's only $1,000 in the bank. And that attorney might say, that doesn't even cover my legal fees. And so they end up dropping the lawsuit. That's one thing that could happen. Another is maybe they go ahead and bring the lawsuit against you. Then all you have to do is just say, look, I got $1,000. You want to check? And then you declare bankruptcy. You wad up that corporation. You throw it away. You go get a new one. You're back in business the next day. Another thing that is good about a C corporation, and I'll just bring this up, is C corporations are allowed to have a fiscal tax year, which means it could be on any 12-month cycle throughout the year. It doesn't have to be January to December. And I'll talk about the importance of that when I get down to the LLC. But that's an important thing that C corporations can do. Again, LLCs can't do that. S corporations can't do that. So let's come over now to the family trust. The family trust is a very important part of this process. And like others, I'm sure you've heard some gurus on the internet talk about the importance of a family trust. And it's great to have one. We don't necessarily agree with everything that you hear on the internet about using a family trust to protect assets. We use it in a very specific way. So the trust is here, as you can imagine. One of the important things about the trust is for estate planning. You want to be able to pass your assets on to your beneficiaries without the fear of taxes, litigation, or probate. That's the important part. Now, one thing that's important to me, because I work with a lot of small business owners and I've seen a few things already in my career, is this idea of business continuity. You need to have some plans for business continuity in your business. So what we do, this is a great thing, again, going back to our corporation, we take all of the stock of the corporation and we issue that stock to the family trust. So now your family trust is technically the owner of your corporation. So the family trust holds the stock to your corporation. This does a couple of other things. It adds one more layer of liability protection between you and your company. So again, if someone tries to sue your C corporation, they're going to find out the owner is actually a trust. So now you've got another layer between you and your corporation if anyone ever tries to sue you. Now, another great thing about the family trust owning the stock is you are the trustee. And if you know anything about corporations, the shareholders, the stock owners, the stockholders elect the board of directors. Well, you're the trustee, you own the stock. Who are you going to vote for to be on your board of directors to run your company? And if you're not voting for yourself, that's a completely different conversation. You're going to have that conversation with someone else. We can't help you with that. But the trust is there, like I mentioned, for the business continuity. If something happens to you, or maybe even to your spouse, then without the trust involved, the ownership of your corporation would be in question if something happened to you. That means your corporation would have to go through probate. I don't know if you've ever witnessed a company going through probate. It is not pretty. That company gets completely frozen. It is shut off. Bank accounts get frozen. That means if anyone has any outstanding payments to the company can't collect. If payments are owed to employees, the payroll can't be given out to employees. If you've got suppliers and vendors, you can't make payments to those suppliers and vendors. And so if you can imagine, 12 to 18 months later, when you come out of probate, there is no business left. But if the trust owns the shares of the corporation, you can have a successor trustee. And that successor trustee can allow the company to continue to function while they figure out what to do with it. Are we going to start to wind things down and just shut down the company? Are we going to sell it? Whatever the case may be, your successor trustee can allow the company to continue while they make those kinds of decisions. So that's an important part of having a family trust involved. Now, another thing I mentioned, we do things a little bit differently than other people you may have seen on the internet. Besides the family trust owning the corporation, that is the only thing that we do with the trust. We do not put assets in the trust that will generate revenue, and I'll quickly tell you why. If a trust earns revenue, if it earns income, that means it needs to file taxes. And the tax rates on a family trust are some of the most expensive tax rates that there are in the tax code. That's something we want to avoid. Instead, let's drop down here and let's talk about the LLC for a moment. So the LLC forms a very important part of this strategy. And very quickly, before I forget, the other thing that we do is we include the family trust as a minor member in this LLC so that it is a partner. We want to create a partnership with this LLC, not just a single member LLC, because then the IRS says you're just a sole proprietor, and there are certain tax deductions that aren't available to sole proprietors. It's better to be a partnership as an LLC. You get better advantage of tax deductions. Now, an LLC, if you've done any research online, the LLC is considered a pass-through entity. Now, what that means is all of the profit from that LLC passes straight through. It goes onto your personal tax return, and then you get to pay tax on those profits from that LLC. I'm sure you're already aware of that. Same is true of an S corporation if you've done your research. Now, here's where things are a little bit different from an S corporation. The opposite of that is also true in an LLC. If an LLC loses money, those losses from that LLC pass through the LLC. They go onto your personal tax return. So then you end up with those losses on your personal tax return. Now, again, this is a place where some people kind of stop and they give me a look and they say, why would I want losses on my personal tax return? And I tell them, you do, trust me, you want those losses on your personal tax return because those losses can be used to lower taxable income that you have on your personal tax return. So this is another way that we can reduce taxes through this strategy. So I've already given you several tax reduction ideas. Here's another one. We can use losses from an LLC to reduce your taxable income. And here's how we can do that. This makes the LLC the perfect vehicle to hold tangible assets, such as a personal home, cars, furniture, computers, anything else that is tangible can be placed into an LLC. And the great thing about putting those things into an LLC is now they become business equipment. And business equipment can be depreciated. I'm sure you've heard this term before. If you're new to business, you've at least heard the term. If you've been in business, you know exactly where I'm going with this. Depreciation is the idea that that equipment is losing value every year that it's in service. So that depreciation is that loss in value. Now, the great thing is depreciation is a tax deductible expense. You get to write off that expense, but it gets better. Depreciation does not actually take money out of the business. So you get an expense, but you don't get the loss of cash in the business. So can you imagine how someone who's rather creative in figuring out how to balance depreciation could work the profit in the LLC to the point where you may be paying yourself, but with that depreciation, it all comes out to zero? That's a possibility. Now, it can't guarantee that it'll always work out that way, but that's a possibility. You might be able to pay yourself income out of your LLC and end up with a zero profit in the LLC. You might even end up with a loss in the LLC, like I said, which can go onto your personal tax return. So how does all of this work together then? So we've talked about the three different pieces and parts here, but there's more to the story. The next part of this is the LLC now holds all of these things, and in a sense, the LLC now becomes a rental company. Remember how I said a C corporation is allowed to rent a fully furnished executive home for you to live in? Well, look, this LLC holds the assets and it rents them to the corporation. The corporation pays rent to this LLC. So the cash that's in this corporation flows down to the LLC in the form of rent. And so now the home is earning rent. The LLC owns the home. So what this means is all of these expenses that we have here, all of your expenses for your home, such as mortgage, tax, insurance, anything else associated with the home, maintenance, upkeep, all of those things become tax deductible. The same for your car. If you've got a loan on the car, now that is fully tax deductible. Maintenance and upkeep on the car, gas, car washes, everything becomes fully tax deductible. You no longer have to worry about tracking mileage. You no longer have to worry about just having a home office in your home and only deducting a certain square footage of your home. This way, the entire home is tax deductible. The entire car is tax deductible. So think about that for a moment. If you think about the typical American family budget, think about some of those expenses, those line items in the typical American family budget. Wouldn't some of those expensive, the most expensive things be related to the house or the cars? And when we can take all of those house-related and car-related expenses and shift them over to the business, where now they are fully tax deductible, think about the typical American family budget. What are you left with? In most cases, you're probably left with food, clothing, entertainment, maybe personal debt that you have to cover. And so if you think about it, how much do you really need to live on? So what you do then as the business owner is you come back to your LLC here, and as you need to, you take money out of your LLC. And this comes out in the form of an owner's draw. Now, there's some other things that can be done as well. And once you get into the strategy, we can talk about things like return of equity and some other things like that. But for now, let's keep it simple. Let's talk about just taking an owner's draw out of the LLC when you need to. And like I mentioned, how much do you really need to live on at this point? So you go to the refrigerator, it's a little bit empty. You need to go get some groceries. So take out $300 from the LLC, put it into your personal account, go get your groceries. That's called an owner's draw. So that's where your money comes from. So what we do then, this is what makes this work. We create bills of sale that move things into the LLC. We create rental agreements so your corporation can legally pay your LLC. We create management contracts between these two companies so that money can go back and forth between the two companies, but you must be cautious here. So let me be very, very clear. Just because you own two companies does not mean you can freely move money back and forth between the two of them. Technically, that's called embezzlement. And you can go to jail for that, and you can be barred from owning a company forever for the rest of your life. What you must do is you must have contracts between the two companies that allow them to do business together. One company can send an invoice to the other for additional services. And this is where that comes into play. Remember, I said a C corporation can be on any 12-month cycle for a fiscal tax year. The LLC is always on a calendar tax year. So let's talk about recent situation. As we're recording this, we just ended the previous calendar year. So let's say during that last quarter of that calendar year, you sit down with your accountant, you're doing year-end tax planning for that LLC, and you discover there's a lot of profit in that LLC and you don't want to pay tax on it. Well, your C corporation can send an invoice to the LLC for various services rendered, administrative services, consulting services, management services, whatever. Then money can be moved from the LLC to the C corporation because there's an invoice. Now, let's fast forward a little bit. Now it's time to do tax planning, year-end tax planning for the C corporation. You sit down with your accountant, you discover there's a lot of profit left in the C corporation. Now your LLC sends an invoice to the C corporation for services rendered. You can move that money into the LLC for those services. Now the C corporation has less profit to pay tax on. So all of this comes together. There must be contracts, there must be agreements between the two companies. These are simply two companies choosing to do business with each other. Notice that no company owns the other company. These are two separate companies choosing to do business with each other. So with that, I've now set the stage. I'm going to call on Debbie Faw now, who is going to expand on a lot of these ideas that I've just covered. But now you know where we're coming from for the rest of this conference. Go ahead, Debbie.
Thank you so much, Daniel. Can everyone see my screen okay?
We can now. Go ahead.
Okay, thank you. What I would like to do today is talk about the advantages of using Pratt and LeFevre strategies. And Daniel did such a great job, and so I'm going to reiterate some of the things that he has talked about. So before I joined Pratt and LeFevre and got into the strategy, we had a tax accountant, and he said, make sure you take the square footage of our house, of the office, the business office in our house. And I thought, well, that's great because I have two offices. And so we were able to take the square footage of the office. And then he also said, and make sure you take the mileage of your business travels. Now that's kind of difficult and a lot of timekeeping and everything because my husband is a pilot, but he also is a CDL driver. And so when he had to do the different vehicles and everything, getting in there, writing it down, and keeping track. Okay, this is what we're not doing for business. This is what we're doing for the home, so we can't do that, and just a lot of time consuming. And then we got our 2019 taxes in draft form, and we owed about $6,000. I thought, wow, that is a lot. Now our accountant did not know how to help us. He didn't talk with us throughout the year or anything and you just don't know what you don't know. Now, we've been looking for a business strategy like the Pratt and LeFevre has for several years. My husband asked me, look around, investigate what we need to do to find what the wealthy can do, because the wealthy know how to take care of their businesses and they minimize their taxes, they protect all their assets and everything. And so when I was able to meet up with Pratt and LeFevre and found out that, we only have a single member LLC. And with Pratt and LeFevre, we need to have a multi-member LLC. And with the IRS, they think that the single member LLC is just a hobby business, is just the alter ego of yourself. And it doesn't have any protection for you. And so that was the exciting part of how we were able to work with Pratt and LeFevre, find out the strategies that can help us And our business life really changed and we really felt blessed. And as Daniel said, we have more than one business. We have a corporation now that has all of the public view that comes in. And then we have our LLC that holds all of our assets. For the minimizing our taxes, we don't have to pay $6,000 for taxes anymore. We have to pay just about $30 to the Idaho State for our corporation. I have worked for Pratt and LeFevre for about 5 years. I am a corporate strategic advisor, account executive, and also the processing supervisor. And having being the processing supervisor, I know that the documentation is so important. As Daniel was saying, when we put everything in our LLC, we have to have all the documentation of the bills of sale and the HUD sheet and the installment land contracts. You need to have the contracts and be able to invoice so you can have the money flow that you need. And I've been able to learn so many things about how to act with our business. You need to act like a business and you need to run your businesses a certain way and able to keep our arm's length of the related party rules. And so that's the exciting part of what I have learned. We know that Pratt and LeFevre uses John Rockefeller's strategy of own nothing and control everything. And John Rockefeller was the first billionaire. You know, he knew how to run a business, he knew how to do things. And this was one of his favorite quotes. So we talked about having all the assets in our family LLC, and these are all the different documentation that we use, just as Daniel had said earlier. And that's the most important thing is you need to have documentation. And you need to have, your contracts and your invoices so you can have the cash flow between the businesses by paying contracts and your invoices. Working with Pratt LeFevre, you have an A team. You're not just left alone. You have an A team that can help you along your way. The corporation, you can have different things, and you can have a corporate strategic advisor who can meet with you monthly and help you understand what things that you can buy with what company and how to make sure that you're paying your contracts on time and having the invoices if you need that. We have bookkeepers with Pratt and LeFevre, and the bookkeepers are very important because they're able to take care of your books and you're able to have reports and everything. So when you meet up with the CFO or your chief financial officer, he does tax planning for you. He meets with you quarterly. When we met with our tax accountant, he only met with us once a year and he just took the history of what we had and he didn't suggest anything. He just didn't know exactly how to help us. But with our people, we have different CFOs in Pratt and LeFevre, and you're able to do tax planning. And we also have a tax department that knows the strategy. And that's the important things that all of these people that work with you on the A team, they know the business strategy. They know that we're working with a corporation and they know we're working with the LLC. And with the LLC, since we have all of our assets in it, we are able to have deductions. And so that's the exciting part of that. What if you never had to take the square footage of your home, of your business office? That's exciting. And what if you never had to keep the mileage log again? That really helped my husband because he had to do a lot of record keeping and it took a lot of time. He had to make sure before he had left to write all the mileage down. And when he came home, he couldn't even get out of the truck until he got everything all logged in correctly. So, what are the advantages of having a business? We talked about increased earnings. We don't have to pay $6,000 for taxes anymore. We talked about the reducing the personal and business taxes, talked about the protecting your personal and business assets. because if someone tries to see you, as Daniel said, you don't own anything. And so it's not worth it. And we don't have to keep track of our business mileage anymore because the corporation can pay for all the expenses on your cars. And most people have more than one car, right? And you don't have to take the square footage of your office because your corporation can now rent a fully furnished home, which is very exciting. And we can pass control of all of our assets to our trust beneficiaries without taxes or litigation or probate. And we know because we plan ahead of time through our trust that whoever our trust successor is can and will be able to take care of our business. And they will know ahead of time because you have planned it out of what needs to happen to your businesses. Can you ever get a personal write-off with all the personal expenses you have? Remember, the only thing that we can do is take the mileage and the square footage of your office. So let's talk a little bit about what your personal fixed expenses are. The biggest one would probably be your house payment. And some people don't have a mortgage on their house. They rent, and you can also have that amount. The house and the office maintenance, your utilities, your gas, your propane, electric bill, the water bill, the garbage, the Wi-Fi. There's a lot of utilities and personal items, expenses that we have that we can't write off personally. And we talk about our auto expenses, the gas that fills up, and that the gas prices are always going up and down. The oil changes, the buying oil, the tires, changing into snow tires, all the repairs of your cars. And sometimes people don't own all their cars, and there's car payments, and you can't write off any of those on your personal taxes. And even the interest on your credit card and your auto purchases. So let's say that all of these personal expenses, let's just kind of round these up, that these expenses that you have would be about $3,000. Now, if you had a business, you would be able to pay your fixed expenses and deduct them. So let's talk about how you pay your income taxes. If you're a W-2 wage earner, we know that you pay your taxes every time you get a check, right? And how about your business? When do you pay your taxes on your business? At the very last. So let's talk again about the W-2 wage earner. And let's say that you earn about $5,000. And then you would be in the tax bracket for your personal account between 12% to 15%. And the amount would be about $750. So every time that you have a check that comes, you are able to see that they took $750 out every time. Then you have to pay your fixed expenses. Remember, we talked about that earlier, is about $3,000. And so after expenses, you only get about $1,250. So reviewing this, being a W-2 employee, you give the government, let's say we pay $750 every time they give us a check, times 12, that's $9,000 you give to the government interest free because you are a W-2 wage earner. And oftentimes we get some of that money back, right? But you don't get it back for at least a year or sometimes even longer. You never know. So now let's talk about if you had a business and having the same numbers. Okay, if you had a business and you earned $5,000, The first thing you do is you are able to pay your expenses. And we already talked about the fixed expenses, remember? All the fixed expenses for your house, utilities, and all in your car and all of that was about $3,000. So your operating cash is $2,000. Now, with a business, that is what is taxed on. And of course, since you're a business, you have a higher tax bracket, which is about 30%. And so you pay about $600. Now, remember over here, being a W-2 wage earner, you have a less tax bracket, but you're actually paying more taxes because as soon as your money comes in, you had to pay your taxes. Having a business, you pay your expenses first, and whatever the operating cash is, that's what your taxes is taxed on. So after tax profit, you have $1,400. So in just this small numbers, you have a net gain of $150 more than you do personally. And so most of all the expenses that you have personally, your business is able to pay for that, which is so exciting. We really like that. So let's talk a little bit about your LLC and your corporation expenses. And we know that we can have all of your assets in your family LLC so you can have depreciations. Let's say your house is worth about $600,000. For 27 and a half years, you're able to depreciate that. So what does that mean? That means $21,800 you're able to take off for the depreciation off the profit of your business. And let's talk about your cars. If your car is worth 36,000, you can depreciate that for 5 years. And that equals to about $7,200 is also taken off. And so that is great to have all these depreciations. And we put the household furnishings in there and the electronics and everything. And so they're all depreciated. And what else does the LLC pay for? It pays for, remember, all the utilities you have and your gas, your garbage, and all of that, propane, everything. And then your property tax. And property tax is so different in different states. I live in Oregon and our property tax is about $3,500. People who live in New Jersey, it's about $21,000. And you, personally, you can't take any of that expense off. How about the car insurance? Most people have more than one car, and you could pay the car insurance with your LLC. There are some people that still owe money on their cars. And so you can have your car payments taken off through your LLC. We know we have yard maintenance and remodeling and everything, and your LLC can take care of all those expenses that you have. As a business, you need to act like a business and you need to make sure that you have meetings. So, with your LLC and your corporation, you could have business luncheons. And having your business luncheons, you're able to talk about your business plans and for the future and the marketing and all of that, and be able to take minutes from those meetings because you're acting like a business and making sure that you keep the businesses using the KISS program, the KISS, keep it super simple and doing all the things to make it acting like a business. So now let's talk about the corporation, what kind of expenses your corporation has. So we know the corporation is now renting a fully furnished home, so they're paying at least half the mortgage. Now, how much mortgage does your LLC do? Your LLC pays for the full mortgage. So in that scenario, your LLC is paying the full mortgage and able to write off that expense from the LLC. Your corporation is also paying half of the mortgage to your LLC, and so that is also expensed out. So you're expensing out the full mortgage and half of the mortgage just in the business's expenses, which is very exciting. The corporation is also paying for all of the gas for all of your cars that you have, all the maintenance you have for your cars, your oil changes, your tires, all the expenses you have. The corporation gets to expense that out. And remember, for the LLC, for your cars, they're depreciating the cars. They're also paying if you have any car payments. They're doing that too. We know that a lot of us have dentist appointments and doctor's appointments, and you cannot expense that out for personally, but you can through the corporation, because the corporation, the C corporation, has the HRA, which is the Health Reimbursement Agreement. So what does that mean? Doing that, you personally will be able to go to the dentist if you have any copays, if you have any appointments that you're paying for, you can keep the receipts. Also, going to your doctor's appointments, you're able to keep the receipts of that in your copay, and you turn all those receipts into the corporation. And because the corporation has the health reimbursement agreement, they're able to reimburse you with all the things that you had paid without any taxes to you. And it's just an expense for your corporation, which is so exciting that you don't have to, you get reimbursed for that. The corporation can also pay for your telephone bills. And when you have to get new telephones, it can pay for all of that. Why do you think you should hire your children? There's different ways and different advantages of hiring your children, because your children can be a 1099 wage, becomes a business deduction if it is just a family LLC. And it also helps them learn how to earn money and work and know how to spend money too. So it really helps your children if you do hire them. In 2024, you're able to pay your child up to $14,000 a year per child to up to the age of 18. There's no employment or wage taxes that they have to pay. The LLC doesn't have any of the payroll or anything taking the taxes out or anything. It's a legitimate work for a normal pay. They need your child, and you can help them. They need to keep the work hours of how many hours they work and the type of jobs that they do. And so they can help you with your businesses of different things, which is so exciting. So now that the children have money, they're able to pay things. They're able to pay school clothing, their school activities, their sports, piano lessons. They can do all sorts of things with the money that they have earned. And as parents, you're able to set aside some of that money. So you can start early in paying them through the LLC so they can have their child's education and start saving for their college education, which is so important for them to learn how to work and to be able to save for their future. Now, most of our expenses that we talked about are now paid through our businesses, which is so exciting. So we need to remember when we talked about all those fixed expenses, that you cannot pay for personally, that you can pay for through your businesses. And your business, your C corporation pays for certain expenses, and your LLC pays for certain expenses. So we know what the certain expense, the fixed expenses are of taking care of your home and renting it or paying the mortgage. Also, the home and the office maintenances and all the utilities you have and all your car expenses. You have gas expenses, oil changes, buying oil, buying new tires, the rotation of tires, and the repairs you have, the car washes. So many things that pertain to your car are now your business expenses. And all the interest, credit card, auto expenses you have, and you have your own bank accounts for your different businesses, and you can use your debit cards, or if you have a credit card for your business, to pay for all of these expenses now that your business does, to keep track of all these expenses so that your bookkeepers can keep track of all the expenses in the businesses that you have. And we talked about the only thing that you have to pay for personally now, with all your fixed expenses that we talked about that the business pays for, are your groceries, your clothing, and your entertainment. So you don't have to have so much money anymore because your businesses will take care of it, which is very exciting. I would have you contact Pratt and LeFevre Corporation for a free consultation. This is a telephone number that you can use. And what can we do to take advantage of all this different items is minimize your taxes. We minimized it at least for $6,000, and protect your personal assets. Oftentimes, when people are thinking about their business, they always remember about their business assets, but they kind of forget about their personal assets of how to protect those. And that's how we do it, through having all of our business and our personal assets in our LLCs. You can hire your children, and that's a great amount. They can get $14,000 a year hiring your children so they can start paying for things. They can start learning how to use a budget, and you could help them start saving for their college. And as Pratt and LeFevre, we work within your budget. We, when we have our consultation, we find out what is best for you, and we work within your budget. We're able to have step by step of helping you work with that. The money you save with your taxes, you would be able to start the business strategy. That's what we did when we started our business strategy with Pratt and LeFevre. And saving on your taxes, there's more money to help save your business, and so you can grow your business. Thank you very much. I really appreciate this. Now I'd like to introduce Omolola. She will be the next person that will be able to share what she has for us. Thank you so much.
Hello, everyone. Hope everyone can hear me.
We can.
All right. Okay, very good. Good. Thank you, Daniel and Debbie. They've covered so much. I'm so excited. I'm going to try and help you all look at this really fantastic and fundamental thing that all of us as business owners should be doing through Pratt and LeFevre. Just going to try and shift your let's go into our minds a little bit with our business and look at how this really helps us. Okay, so there are two key things I feel business owners really should always be concerned about. That's tax efficiency and asset protection. So we're going to dive into those two areas because they're absolutely crucial. And these are not just technical terms. They are game changers that can mean the difference between a business that struggles and one that thrives. So my goal is quite simple. My goal is to show you how the right business structures that you've heard so far, the tax strategies and asset protection tools will help you keep more of your money, legally reduce your taxes, and protect what you've built. So let's dive in. So why business structure? Why does it matter? Let's start with a fundamental question. How is your business structured? Is it a sole proprietorship, an LLC, a partnership, or a corporation? The business structure isn't just a formality. As you've seen, it impacts how much tax you pay, how much liability you carry, and how attractive you are to your investors. So think about it this way. If you're a sole proprietor, your personal and business assets are the same. That means if your business faces legal trouble, so do you personally. And that's not a good situation, right? But with a properly structured LLC and corporation, as both Daniel and Debbie have shown us, you create a legal separation, protecting your personal assets from business liabilities. And it's not just about protection. It's also about the credibility which you give yourself in that instance. If you're looking for funding from investors and lenders, they'll take you more seriously if you're structured as a corporation or an LLC than if you're operating as a sole proprietor or a freelancer. So, step one in building a strong financial foundation is choosing that right structure for your goal. That is what Pratt and LeFevre always does with this system. You've heard a lot about how these taxes can work, and Debbie has really shown us in such a practical way. I just wanted to add a few things or just reiterate some of what she said so that it kind of sticks. Because when we hear something over and over again, we're able to really think about it. I know we don't like talking about taxes, but this is where many entrepreneurs lose money without realizing it. The good news is that businesses have tax advantages that individuals simply do not. Let's break it down. So if you earn money as an individual, you pay taxes first, as you've seen, and spend what's left. But as a business, you can earn money, pay your expenses, and then get taxed on what remains. That is the big difference, right? So for example, let's say you have $5,000 in revenue. And if you're an individual, the government takes a cut right away. But as a business, you can first deduct expenses, things like the marketing, office space, travel, and even some personal expenses like health insurance from the corporation, the health reimbursement, as Debbie pointed out, and it gets even better with the right structure. You can live legally, you are now able to legally shift income to reduce your tax. And that's where we talked about depreciation. That is the way of writing off the value of business assets over time. This means you can report less taxable income while still having valuable assets in your business. Fantastic. And you know what? The wealthy use these strategies all the time. So why shouldn't you? Now, always remember, the key thing I would like you all to take away when we talk about taxes here is that the tax code rewards business owners. So the more you understand it, the more money stays in your pocket. That's what Pratt and LeFevre strives and aims to do for small business owners. Now, one very key area that's really dear to my heart is asset protection. And we're going to talk about it just a little bit, and it's something many business owners ignore until it's too late. So let's think about our businesses like our homes or a house. You wouldn't build a house without insurance. But many business owners operate without any legal protection, which is leaving the doors unlocked and hoping, nothing bad happens. This is where trusts and layering entities come in. A trust can shield your wealth from lawsuits, creditors, and even excessive taxation. So if you own real estate, investments, or you're growing your business, setting up the right kind of trust can be the difference between securing your legacy and losing everything to legal claims. Then there is the layering, which you've seen with the corporations and the LLCs. Think of, layering like dressing for winter. You don't just wear one thin shirt. You add thermal layers, a sweater, a coat. The same thing with business, with having a sound business organization. Business entities work the same way. So by using a combination of the LLCs, corporations, and trusts, as you've seen, you're creating multiple barriers that make it harder for lawsuits or creditors to reach assets. The key message here is protect what you build before you need to. Because by the time you need it, it is usually too late. Make a quick shift. How can we bring all this together? There's one key thing I always like to point out is, let me see if I can I share my screen, Boyd? Or, yeah. All right. I always like to talk about, Robert Kiyosaki's cash flow quadrant. And the reason is understanding structuring really made me see the point of what he was making. And I hope it makes sense to everyone today. We have the active side and the passive side. So under the active side, you have the employee and the self-employed. And then under the passive, you have the business owner and the one who makes their money work for them, the investors. So most people are stuck in the E and the S quadrants. They work hard, they pay high taxes, and never really get ahead. But the goal is to move to the B and I side, where businesses and investments work for you. And the secret to doing that is smart structuring, tax efficiency, and asset protection. All the things that we're talking about here today. So the goal is to move, for every business owner, the goal is to move from the left side to the right side to achieve financial independence and true wealth. This transition is where trusts, corporations, and LLCs play a pivotal role. By operating on the B and I quadrants, you can then leverage your assets and investments more efficiently. These entities facilitate wealth preservation and asset protection by allowing you to manage your financial affairs with more control and flexibility. So, my challenge is, where do you want to see yourself now? And more importantly, where do you want to be? So, we've covered a lot in a short time. I'd like to just recap a little bit. Your business structure impacts your taxes, your funding potential, and your liability. Remember, the tax code is designed for business owners. Learn to use it. Protecting your assets isn't just smart, it's essential for long-term success. The goal is to move from being self-employed to being a true business owner and an investor. One thing I must say that this process has helped me do more is really understand my money and really make sure that I am being very particular about how my business is growing. I now have to do bookkeeping, and I have to meet quarterly with a CFO. So it's been a great help. And I'm really, really grateful, for what Pratt and LeFevre provides for small business owners. Because many times there's this feeling of, oh, this is too much. I don't think I can do this. But Pratt and LeFevre really makes the process smooth, and you always have trustworthy people who know the system and understand the structure to help you on. So I encourage you to open your eyes to what's possible. And don't stop here. I invite you to book a one-on-one strategy session, us and Pratt and LeFevre, and we can dive into your business and create a more personalized plan for tax efficiency and asset protection. I want to thank you all for your time today, your energy and your commitment. Being here shows that you are ready and you are committed to making your business thrive. I now want to call on our next presenter, Ronald Haycock. Thank you.
Thanks, Omolola. So I want to brag on these if I possibly can. The Omolola is one of the attorneys that work with us, and she's out of Georgia. Daniel McCraine is an absolutely genius when it comes to organizing and helping people organize their business. Debbie is just as, we couldn't do it without her. She knows everything about this company and about how to help businesses. And Boyd, I want to thank you for helping us put this together. Appreciate it. Boyd is great in marketing and helping us out with our internet things. Now, you heard the premise, own nothing, control everything. What do you want to own? Well, what do you want to control but not own? First off, you want to control your personal stuff, but you don't want to own it. Whatever you own can be taken, just like you heard here. Now, Omolola made a comment that she wanted this to be attractive. Well, it's a good thing you probably can't see me on here, because being attractive is not one of my strong suits. There we go. I was told to turn that light on, forgot to do it. It's not one of my strong suits. So let's, and I'm not sure that John Rockefeller, whose picture that is very attractive either, but we're not looking at personal look, right? We want you to control everything. The biggest thing you've got to control is money. This is what most small businesses look like right here. They are saying, I'm going to go out and do it myself. I can do this. I know better than anybody else. I can do it. Or just like a guy told me the other day when I was talking to him, he said, well, my attorney did it for $100. No, my accountant did it for $100. And I said to him, what did he do? And he said, well, he put me on the internet. He got me, he put me registered with the state for $100. Big deal. No structure, no foundation, no support system. So my friends, dream your mansion, build your log cabin first. Keep it simple. How many people don't know what the businesses are? Here are the different types, as Debbie was talking about, and as Daniel was talking about. First off, you need to know the differences. If you are a limited liability company, you'll be taxed either as an LLC partnership, as an LLC sole proprietor, as an S corporation, or a C corporation. LLCs do not get taxed on their own. They don't pay taxes. They just own assets and pass either the profits or the losses to the owners, to the entrepreneur. I've done a study, and I've had a couple of the people here in our organization that have helped me. 23 tax disadvantages for S corporations. We do our strongest pursuit as much as we can to persuade people not to be S corporations. Now, when you are in business, there are 4 sides to building a business. You're the management. You need an accountant. You need an attorney. You need an estate planner, just like you were told here. One of the things I discovered, I bought my first business in 1974. And I couldn't get it to run right. Well, I'd go to my accountant and he'd tell me, give me something of advice. Then I'd go to my attorney because I needed some legal advice. And often it was conflicting. I got confused. I didn't know who to believe. I was 29 years old at the time and running around in circles. And then what most people don't realize is that they need to have their estate involved. Just like Debbie and Daniel said, with an estate, with a trust, Probate is absolutely not required. And you can continue to running, or your family can continue to run it and continue to earn the money whether you're around or not. And it does not come to a stop. It can be done. Okay? So those are the things we want to be considered. What ones do you use? When do you use it? How do you use it? How do you work together? And they're all taxed differently, so you need to know how that happens. Okay? So one of the things that, I don't know whether you've ever heard of Laura Langemeyer, but she wrote a book called The Millionaire Maker, right? Act like a millionaire. If you want to be one, act like it. And most of them have more than just one organization. They can maximize their tax strategies. They create limited liability protection. They use them together. And that's what we want you to consider. Now, Debbie already went over the idea of W-2 versus business expenses, right? So let me tell you a little bit of a story about interest, right? There was a guy that I know pretty well, a very strong leader in our state here. And when he was just first graduating from college, he got a job in Boston. And he thought he was smart because he had an MBA. So as he walked in for this job in Boston, the receptionist said, Mr. Smith, the president wants to see you. So he goes up to the president's office, and they knock doors and shake hands, knock on the door, shake hands, sit down and have something to drink. And the president said to him during the middle of this conversation, he said, Tom, tell me what the interest is. Give me the definition of interest. And of course, Tom's trying to figure out this book definition because he just graduated from college. He's smart. And the president of the bank said, remember this, interest is, to them who understands it, is those who gets it. Those who don't understand it, them who pays it. You need to get interest on everything you do. Instead of paying it out, you earn it. But you earn it without having to pay a lot of taxes on it. Okay? Now, the way you protect yourself, let's talk about that real quickly. Get my glasses on so I can see what I'm doing. Okay? Let's talk about how to protect yourself. Okay? You want to be able to take your fixed expenses and legally and ethically have the business pay for them. And the reason they can do that, and I've got, by the way, just for information purposes, if you're interested and you want some, I have a whole bunch of different handouts because I give seminars all the time. I can give you a lot of these things here that tell you about putting your home in, contributing other assets to businesses, right? If you're a renter, turning rental properties into businesses, not investments. There's a lot of things you can do and should do. If you want them, let Boyd know, and we'll get copies of these for you. But what we want you to do is to take your fixed expenses legally and ethically by documentation, as Debbie and Daniel both said. It has to be documented. The IRS has related party rules. You're related to your business, and each entity that you have in your business, they're related to each other. You're related to yourself and to them. You've got to separate yourself. You cannot do these things just because you want to move money. You've got to move them reasonably and by contract. You've got to follow the formalities. It's not the structure that protects you, it's the formalities that protect you. Now, I'm from Utah, love to ski. I used to be one of the staff accountants for a ski resort before they sold it out. While I'm on the ski slopes, nobody sees me. They don't see any skin at all. They have no idea. If I talk to them on the slopes, they still don't know who I am. I go down to the ski shop at the bottom of the hill and buy myself a chocolate or a sandwich, take my coat off. Nobody knows me. My coat is my brand. Underneath it, I have a bunch of layers. That's what protects me. That's why we want you to set up, but they have to be individual and separate. Now, here's the trick that Debbie and Daniel, what we're both talking about in Omolola. The idea is I'm a clumsy skier. I fall down the mountain and I rip a hole in my coat because some branch pokes at me. All of a sudden, the cold's starting to affect all my underneath layers. What do I do with that jacket? I'm not going to try to fix it because it's still blemished. I'm going to go down to the bottom of the hill as fast as I can get there. I'm going to throw the jacket away. I'm going to buy a new one. I'm going to start all over again. I lose nothing because the jacket on top, the visible company owns nothing. So as was told you there before, here's the organization. Now, just let me make some things clear so that you understand. The trust is revocable because that gives you control. Irrevocable trusts take the control away. In 1982, I had a business treasurer, a corporate treasurer, that embezzled $150,000 of trust funds. And when that happens, when we have trust checks bouncing, the state shuts me down. I had no choice. And they just started doing research and found out our corporate treasurer was the one that actually embezzled the funds. So my attorney came to me and said, Ron, let me help you get reorganized. He showed me how to do this, but using an irrevocable trust. And I thought, the trust is a good idea, but I lose control. An irrevocable trust, I have to put it in place, put my assets in there. I lose control of everything. But a revocable trust, a living trust, doesn't protect assets. It can be busted. And I've had several clients that have had that happen before they came to us. The idea is use the trust for control. As was explained earlier, you would be the trustee. You elect yourself as chairman of the board and one of the board members. But while you are the trustee of the trust, when you are in the trust, you act as the trust, not as your individual self. Then you move over here to the corporation because you act now in that capacity. You are the corporation. You are no longer the trust. And your LLC holds your assets. You act in that position as a manager of the LLC. But it has to be with the formalities. It has to be with contracts. Those things are really critical. And the corporation rents from the LLC the automobiles and the furniture, also rents an office in the home, and rents all of the furniture for that office in the home. But the biggest thing is that LLC is going to be getting money in here to pay the bills. If it needs more money, it has a contract between it and the C corporation and another contract between the corporation and it. So it's backwards. So if the LLC needs money, it sends an invoice to the corporation and the corporation pays that invoice, which is a tax deduction to the corporation, but it's income to the LLC to cover the expenses. At the end of the tax year, as Daniel said, there's a fiscal year here. The C corporation, because it's self-contained, doesn't pass anything through, can have a fiscal year. That means it starts anytime in the middle of the year and goes 12 months later. So we usually start our fiscal years for our companies, for our clients, either in April 1st, July 1st, or October 1st, at the beginning of each quarter. But now, let's say it's starting in July, and the corporation's earning too much money. In June or May, when we sit down and we have a tax meeting, then all of a sudden the LLC receives an invoice from the corporation, or the corporation receives an invoice from the LLC, and the corporation pays that invoice. Now at the end of the tax year, it has no money left in it, but you control the money. You get to keep whatever's left over to use for your business growth. And if the LLC starts making too much money towards the end of the calendar year, the corporation sends it an invoice and it packs money back to the corporation. And it's never the same amount because you're going to spend it. You're going to use it for your business growth. What we want you to do is to be able to have an organization. We want your business to be structured. It might be ugly, it might be simple, but do it that way. And the KISS principle that Debbie told you, she made it really nice. Thanks, Debbie. But I'm not going to be so nice. KISS stands for keep it simple, stupid. But my wife won't let me call people stupid, which I do on several occasions anyway. And so I say keep it stupidly simple. Dumb it down. Make it easy to get in, easy to manage, easy to get out of if somebody comes after you without losing anything. So what we're doing is organizing for you and have organized in almost every state that I can think of. I think right now we have clients in 45 or 46 states. Excuse me. And we have all of these organizations, these professionals working with us. Omolola happens to be one of our attorneys. We've got 2 trust attorneys, and we have litigation attorneys. We have real estate attorneys. We've got a lot of people that work with us, okay? But they don't work with us or our clients until we have brought them inside the organization so that they can see what you're doing from the same point of view. So that when you go to an accountant or you go to an attorney or you go to some of the other people, the estate planners, they don't give you conflicting advice. They see it from the same angle. But we're going to assign you and everybody else at least 3 professionals. The first is a corporate strategic advisor, like Debbie said. She is one. The idea is teach the business owners how to stay in the formalities. The job of the CSA is to make sure you act like a business and not like an alter ego. And then we're going to assign you a CFO, Chief Financial Officer, and they're going to meet with you at least once a quarter, plan the taxes, look over the financial records, look over the income and losses, and decide what to do. But we want to do tax planning based on moving money in between these entities. We want you to be able to learn how. We don't want to just do it for you. We want to teach you what we do, why we do it, and how we do it. And we do it at a cost a lot less than most professionals charge nationwide. Okay, and then your bookkeeping is critical. If you've got a bookkeeper, we'll use your bookkeeper. If you've got an accountant, we'll use theirs. But we're going to have to train them and bring them inside your organization from the same point of view. If you don't, I've got bookkeepers, I've got tax accountants, I've got almost everything that you need in this company to do what you need to have done. And you can work with them, but your CSA is your main contact point. They're the ones that know who these are. If you've got questions, they could go to them, ask the question, bring the answer back to you, and you don't have to pay the professional fees. If you've got something special, for instance, we have a client that has a special need for something in the trust. So they can't just use our boilerplate trust that the attorneys have already prepared for us. They have to have a special trust done. And we introduce that person to the estate attorney so that they can take care of the things the way that the client needs it. We help you do what you need to do when you need to do it. All right. Hopefully that's a recap. You can see why we do things and what we do. So I'm going to tell you a story. And this ends my part, okay? There was this old farmer, had a farm that had been inherited down generation to generation after generation, right? And he'd lived there for a long time, and he decided he was going to sell the farm. So he went out and fixed up the orchards, and there was an old barn. He fixed up the barn, and he fixed up the house. Did really well. Nobody would buy the farm. Not because everything wasn't pretty, because he had an old donkey. Nobody wanted the donkey, and he wasn't going to kill it, right? So he didn't know what to do until one day the donkey fell in the well. And this dry well was there. And that's the other reason that most people didn't want it, because it had a dry well on it. Didn't want the well, but that could be fixed. So the donkey fell in the well, and the farmer said, "Oh, good. I'll just take care of both of these in one swoop here." And he called all of his neighbors in, handed them shovels, and said, "Let's start filling in the well." So all of a sudden, dirt started going in the well. Now, the donkey may have been old, but he wasn't stupid. He knew exactly what was happening. Boy, he put up a fuss, kicking the walls and braying. It didn't last very long. Farmer said to himself, that can't be. It doesn't make, it's been too short a period of time for the donkey to have died already. So he looks in the well, and a shovelful of dirt goes in the well. The donkey just shakes it off and steps up. Another shovelful of dirt, shakes it off, steps up. 2 hours later, the donkey walked out of the well. Now, the moral of the story, life's going to throw dirt on you. You're in business. Businesses are going to throw dirt on you. Shake it off and step up. One more moral. The donkey, like I told you, wasn't stupid, knew exactly what happened, sought the farmer out, bit him on the behind as hard as he could bite. The bite became infected. The old farmer died. Moral of the story? You make a mistake and you try to cover your ass, it's going to come back and bite you in the end. Boyd, thank you very much. And thank you, all of you guys. I love you a lot.
Well, thank you. Is there any questions from anyone that we need to answer? Besides the one, we had one in the chat that said, are we going to have a copy that they could look at? And yes, this has been recorded and it will be put on YouTube, and we'll send a link to those of you that would like. So thank you very much. So any other questions? I guess not at this point. So thank you very much for being here today. And we do have another session that we're going to have 2 weeks from today. It's going to be about tax planning, planning for your taxes that need to be done in March. And so for businesses, so please come and see the strategy and planning that we can help you with at that point. So
Hey,
that'll be
Boyd.
2 weeks from today. A different set of people will be presenting. And then in a month after that, on the, I think it's the 19th of March, we will have another session that will be talking about, my notes weren't on top. We're going to be talking about, asset transfers, transferring and selling a business and things like that. So it's all about moving the business on or selling the business or retiring, those kind of things. So thank you for being here. And
Boyd?
Yes.
Before you hang up, I'd like to find out if there's anybody on this call that would like to see or have me send them any of these documents that I was telling about, these things that prove the point and so it's just not our word. They can see that there are other professionals out there that understand it and that it's legal.
So what I would like to do is get those things and we'll put it on the YouTube channel so they can download it when they see it there.
Okay.
So that way they will have it and they can download it all then. Okay.
All right.
All right. Thank you.